Hi, welcome to Chapter 17, Future Markets and Risk Management. So in this chapter, we're going to be talking about mostly futures, but a predecessor to the future contract is a forward contract, which are still in existence, but this was the original concept, which would be an agreement to buy something that you're going to receive in the future at an agreed upon price today. So the idea is that if you know you need jet fuel or oil or corn or something in the future, 6 months in the future, set the agreement today, agree upon a price and agree upon a date of the delivery, and that would be your forward contract. Now, when we're looking at a futures contract, it's more of an organized, standardized contract for an exchange. So on a futures contract, we have some basics with the future prices, which is the agreed upon price paid on a futures contract at maturity. And you can take either a long position or a short position. So a long position is a trader who commits to purchasing the asset, and a short position is a trader who commits to delivering the asset, or selling the asset. Now, if we look at these scales, we can see the profit for a long, a short, or if you buy a call option. So there, basically, if you're buying long, you're going to profit if the price goes up. And if you're selling short, you're going to profit if the price goes down. And the option contract would just be the difference between the premium to collect your payoff. So you have to really kind of strike out the premium. Now, let's just talk about some basics of the contract. So a futures contract is a commitment to deliver or accept delivery of a certain quantity of an asset for a specific date and time, an agreed upon time. Now, here's a list of some sample futures contracts. And you can see they're on a variety of different types of assets. So the futures market establishes their own contract specifications. So the market, like the options market, tries to standardize and homogenize the contracts so they're more easily tradable. So these include not only the quantity and quality of the underlying asset, but also the delivery procedure and month. So the delivery month in the futures contract is much like the expiration date on the options. It's specifies when the seller must deliver the underlying asset, and thus defines the life of the contract. For example, if the Chicago Board of Trade specifies that each of its full-size soybean future contracts will involve 5,000 bushels of USDA number 2 yellow soybean. Soybean delivery months are January, March, May, July, August, September, November. So the trading hours of the future contract vary on the type of contract and whether the trading system is an open outcry or electronic. So the open outcry auction is somewhat a chaotic approach to trading in which traders shout out to each other to indicate the trades that they want to make. And hours of the open outcry are limited, where the electronic trading can operate 24 hours a day on most weeks. Now, the clearinghouse and open interest, when we look at this, we're basically trying to get an idea of how the contract is positioned. So today, most of the trading is electronic. The trading pits don't really cover as much volume as they used to. So once a trade is agreed upon, the clearinghouse is going to facilitate the trade. They're going to come in, and rather than having the long and short trades hold contracts with each other, the clearinghouse becomes the seller of the contract for the long position and the buyer of the contract for the intermediate position. So the clearinghouse is going to deliver the commodity to the long position and pays it for the delivery to the short position. So consequently, it's going to be a zero-sum game, or the position is going to net to zero. So this agreement or arrangement makes the clearinghouse the trading partner for each trader, both long and short. So they sit in the middle, and they're going to facilitate the trade, which means you never really have to come in contact with the other party on the other side of the trade. So the clearinghouse is going to be bound to perform on the side of each contract. So it's the only party that can be hurt in the failure of any trader to honor the obligation of the contract. So this makes you, as a trader, almost risk-free because the clearinghouse is going to guarantee the other side of the contract. So this is necessary because the future contract calls for future performance, which cannot be easily guaranteed in intermediate stock transaction. So when you close out the position, you basically reverse your trade. So if you're long, you buy a short. If you're short, you buy a long. Or you can take or make the delivery. So most trades are reversed and don't involve actual delivery of physical goods. It's just sort of you buy a contract, you sell a contract, and you keep the profit or the loss, and it just nullifies the contract rather than ever actually taking delivery. Now, open contracts are not offset by reversing trades. So an open interest is just the amount of contracts that are outstanding. So if we look at the long and short positions, they're not counted separately, they're counted together. So an open interest can be defined as either a number of long or call contracts outstanding, and the clearinghouse position nets these contracts to zero when it wants to calculate the open interest. So when the contracts begin trading, the open interest is at zero, and then as time passes, the open interest increases progressively as more contracts are entered. So if we look at this, we have a long position, so the money is going to go to the short seller and the commodity is going to go to the long position. Now that's if you take delivery. In option B, the money will go to the clearinghouse, and then the clearinghouse will pay the money to the short position, receive the commodity, and deliver the commodity if you want. So the clearinghouse, you can see how it sits in the middle in this graphic. So marking to market and the margin account is another example of how buyers can be involved in the market. So the total profit or loss realized by a long trader who buys a contract at time 0 and closes or reverses it at time t is just the change in the futures price for the period. So F1 minus F0, or short trader would be F0 minus FT. So the process by which the profits and losses are accrued to traders is called the marking to market. So this is really how you are going to notate your profits or losses. We call that marketing or marking to market. So it's just the term used in the futures world. So in the initial execution of the trade, each trader establishes a margin account, and so how the margin trading works by buying on margin means putting up only a fraction of the total price in cash. So margin is the amount of equity that goes into the deal. So all future contracts are traded on a margin basis. This is pretty standard. So the margin requirements usually range between 2 and 10%, depending on the contract's value. Now, this is very low compared to margins for stocks, which are set at 50%. So furthermore, there are no borrowing required on the part of the investor to finance the balance of the contract. The margin deposit, as the margin is called with the futures, represents security to cover any losses in the market value of the contract until that may result from adverse price movements, which is simply a guarantee to fulfill the contract. And if your margin or your equity in a position runs out, you have to refill it to maintain that margin or that margin of error or protection. So the required margin deposit is going to vary according to the type of contract and depends on the price volatility of the underlying asset. In some cases, it varies according to the exchange on which the commodity is traded. So it really depends on a couple of factors. So compared with the size and value of the future contract, margin requirements are very low. And that's what can make them extremely risky, because you can only need to put up a very little amount of money to get a very large position. So the initial margin is the capital the investor must deposit with the broker when initiating the transaction. Typically, the initial margin is the amount is slightly lower for hedging transactions. So the market value of a contract will rise and fall with the price of the underlying asset goes up or down, and that fluctuation triggers changes in the amounts of margin on the deposit. So to be sure that an adequate margin is always on hand, investors must meet a second margin requirement, what we call the margin maintenance, which is similar to what we talk about in stocks. The margin maintenance, which is slightly less than the initial margin, establishes a minimum margin that the investor must keep in the account at all times. So, for example, if the initial margin on a commodity must keep in the account is going to be 1,000, and the initial margin we'll say is 1,100, and the maintenance margin is 1,000. So as long as the market value of the contract does not fall by more than $100, they don't have to bring any additional money into the contract. But if the contract does fall greater than $100, they lose that cushion, they reach the margin maintenance, and then they must make up, to trigger a margin call. Now, if we look at this convergence, which is the futures prices to the spot prices, so a commodity is available in two sources, what we could call the spot and the futures market. So the spot is like the cash market, the now market, and the future market is what we think the prices will be in the future. So they must be priced identically, or else investors will rush to purchase one from the cheap source in order to sell it to the higher priced market. So such arbitrage activity could not persist without prices being adjusted to eliminate the arbitrage opportunity. Therefore, a futures contract and the spot price must converge at maturity. This is called the convergence property. So basically saying that, yes, spot and future contracts can be different values, but when the future contract reaches maturity, it has to be valued at the spot price, which is the now price of the cash price. So like if you go to the gas station, you fill up your car, whatever the price of the gasoline is or the petro, that's the spot market you're buying today. If you buy a future contract saying you want to lock in the price of gasoline in the future, that could be different to whatever the spot market is today, because we're talking about 3 months in the future. But when we actually reach the end of that future contract, it's going to have to equal the spot market or the convergence. All right, so cash versus actual delivery. So there's which I was talking about this a little bit before. There's a cash settlement where you just settle out in the cash value of the underlying asset to be delivered to satisfy the contract. So there's no actual delivery, it's just a swap of cash. Now, actual delivery is something different. That's when you actually take delivery of the barrels of oil, the bushels of wheat, or however they're measured. Now, as far as regulations on the futures contracts, they're going to be regulated by the Commodities Future Trading Committee is going to produce the regulations, and exchanges can set limits on day price changes, how much the price can change per day. Taxation is paid at year end on cumulative profits or losses, regardless of whether the position is opened or closed. So, just to get back on the cash settlement, some future contracts call for a cash settlement, and that's pretty much what you would expect. It sounds pretty much to what you would expect that would be. So a stock market index and future contracts where the underlying asset is an index, let's say the S&P 500, delivery every stock in the index clearly that would be impractical, impossible. So hence the contract calls for delivery in the cash equivalent of the value of the index at maturity date. So you don't actually deliver the index, you deliver the cash equivalent. So the sum of all daily settlements from marketing to market results in the long position realized in the profits of the contract. So it's just really settling in cash rather than settling in actual quantity. Okay, so let's talk about some trading strategies. Now, we have speculators, the speculation, and we have hedging. So what this is going to establish is, where am I as an investor? So as an investor, if I want to take purely a speculation, then the speculators are going to hope to capitalize on swings in the commodity prices by going short or long. So they want to guess, if they think prices are going to go down, they want to go short. If they are estimating or think prices will go up, they want to go long. To see why a speculator would go long when prices are expected to rise, you assume that you may buy a June 2021 gold contract at $12.87. So by depositing the required amount of initial margin, say $3,000, one gold contract involves 100 troy ounces of gold. So it has a market value equal to 100 troy ounces of gold. So what we're hoping for, if the gold goes up, we'll make money. So we assume that if the gold moves up in price, then our future contract value will move up, and then we can get a return on that money. And since the initial margin is so small, the returns can be pretty generous. So it's pretty simple. It's sort of like buying a stock. You're hoping the prices will go up, or selling your stock short, you're hoping the prices will go down. So you can speculate by buying future contracts on those commodities that we had specified earlier. Now, there's also hedging. So hedging is another way to utilize future contracts. And it's pretty common that we, as a company, say you're an airline company and you need to buy a lot of jet fuel, or you're a power plant, you need to buy a lot of natural gas, or you're a manufacturer of gasoline, you need to buy a lot of crude oil. So, but you don't need, you're going to need this oil or natural gas or jet fuel, or maybe you're a manufacturer of flour, you're going to need this wheat, and you're going to need it in 3 months. So you could lock in the price today by buying a contract today, so that way if the prices change drastically, if the prices go up a great deal, you can sell the contract, and the profits you make from the contract will offset the cost of the commodity. Or you can accept the contract for delivery. So today you buy the contract for the wheat, and then in 3 months you accept the delivery for the wheat at the price of the contract you originally purchased at. Now, if the wheat had gone up 100%, you wouldn't be affected by that increase because you already locked in your price with the futures contract. And it's the same thing if you want to go short. So if you want to hedge on the short side, you might be the person actually growing the wheat, or extracting the oil, or making the fuel. You can actually sell a contract and say the prices were high today, and they're most likely going to go down. So you can sell these contracts short, lock in the price today, and then deliver the commodity at the end of the contract that you're going to be pumping out of the ground. Therefore, locking in and knowing what the price is going to be on that contract. So it's very useful for natural resources, miners and natural resources who are going to be mining or gathering these natural resources, to do these short sells to lock in the price of their products. So they know that if you're a fracking oil manufacturer in the U.S., and the price right now is pretty good on the future contract, you may want to sell those future contracts now to lock in that price and deliver the oil when the contract matures. So this way you get a better idea of where your price is going to be. So you can hedge your position, if you're the consumer of the commodity, you want to buy the contracts, and if you're the seller of the commodity, you want to sell the contracts. So that way you can lock in your price in the future. But if you think prices are going to go in your favor, you may not want to lock in that hedge, because it can work against you as well. So if you think prices are going to go down, and you sell a contract today, but prices actually go up, now you're going to have to, you basically have hedged your position, so you can't profit from actually selling the real commodity, because you're going to lose that value in the contract you set up. So the basics of hedging. We have a basis, which is the difference between the futures price and the spot price. So the basis risk is the risk attributed to uncertain movements in the spread between the futures and the spot price. Now, the spread futures is taking long positions in the contract of one maturity and a short position in another of the same commodity. So we can kind of spread that and hope. So if there's any real volatility, say in oil, you can make money if it goes up a lot or goes down a lot either direction. As long as it's volatile enough, you'll make money on the spread. So these are just some some hedging basics. You can hedge if you're a producer of the commodity by selling. You can hedge if you're the consumer of a commodity by buying, and you can take a spread position if you feel like you want to make money, whether or not there's any type of volatility in the position. So there is a spot futures parity theorem, which is going to simultaneously take a short position in the futures. So it's the all-in cost of purchasing commodity and storing it, including the cost of funds, must equal the future price to prevent any arbitrage. So this is just a way of mathematically, don't worry, nothing like this will be on the exam, but it's just a no arbitrage condition where we can look at this formula to basically say the futures price needs to equal the spot price minus the carrying costs. Okay. just another example of that. So here's the S&P 500 monthly dividend we could look at, which is going to could be a factor in the contract as well. So, because a big area of future contracts are stock market indexes. So, if you're a mutual fund manager or a large hedge fund or a large pension fund, you may want to be buying stock index futures to protect your position. So, if you think there's going to be a crash in the stock market, but you don't want to sell all your positions, you could hedge them by utilizing these stock index futures. And so we know what indexes are, stock indexes from previous chapters, so you can actually trade these at a high leverage position using a futures contract. Also, gold futures are very popular contracts to be involved with. And when we talk about these stock index futures, they're going to be available on pretty much any stock index you can think of, domestic or international. And there's advantages over direct purchases of shares of stock. So you're going to have a much lower transactional cost because you're just buying one futures contract rather than 500 individual stocks. And it's going to be much easier to implement in timing in allocation strategies for, say, pension funds or time-related funds. It's going to work to your advantage. Here are some of the future stock index contracts. S&P 500, Dow Jones, NASDAQ, Russell 2000, the Nikkei, the FTSE. These are all different. And each contract has a different contract size and may be working through a different exchange. Okay. Here's just some correlations among U.S. stock market indexes and monthly returns. So you can create a synthetic stock position. So if you want to create a synthetic stock purchase, you can purchase stock futures instead of the actual shares. This is going to allow for a lower frequency of trading and lower costs, and it's going to be useful, especially for foreign investments. So the classic market timing strategies, you can switch between treasury bills and stocks based on market conditions. So it's cheaper to buy treasury bills and then shift back into the stock market by buying and selling the stock index futures rather than the actual stocks themselves. So it's just a mechanic. Usually a lot of hedge funds will use this mechanic. Now, as far as index arbitrage, remember arbitrage is uncovering a price difference to make a profit. So exploiting this mispricing between underlying stocks and future contracts, so the future price is too high, we can short futures and buy underlying stocks. But if the future prices we feel are too high on the long positions, we can sell the underlying, on the long futures, we can sell the underlying stocks. And this is way, we can theoretically make some money on this index arbitrage. But it's very difficult in practice because the transaction costs are very large and the arbitrage profits are usually very small. So sometimes program trading is the solution to kind of getting some money out of this arbitrage, but it's very small amounts, so the program trading have to be very large volumes. Now, you can also do future contracts in foreign currency. So you have your forward contracts in currency, and remember, many companies are going to be accumulating or selling foreign currencies based on buying and selling their commodities, and so banks usually offer these to companies to help hedge foreign currency transactions. So if you're, say, a European company with an American subsidiary that's generating a lot of American dollars, you can buy a contract to protect between the fluctuations between the American dollar and the euro. So this is a way you can hedge your foreign currency exposure. So the future contracts available for major currencies are the Chicago Mercantile Exchange, also the LIFFE, and they usually trade March, June, September, December delivery on the contracts that are available. So again, this is a way for companies to hedge their foreign currency exposures to prevent unexpected losses based on currency changes. Here's just a list of US dollar foreign exchange rates of currencies that have future contracts available equivalents. Okay, there's also future contracts on interest rates. So you can have interest rate futures. So if you're worried about interest rates changing, these contracts can include be involved with euro dollars, treasury bills, treasury notes, treasury bonds. Some foreign interest rate contracts are also available, and you can take a short position in the contracts will benefit you if interest rates rise, and a long position if interest rates fall. So this is basically a way, if you have a high amount of interest rate exposure, you could hedge with these financial futures. So the hedging is going to require what we call a cross hedge. So hedging in the spot position with a future contract that has a different underlying assets is something that we want to look at. We could also talk about swaps. So a swap is when one party agrees to pay a fixed rate of interest in exchange for a variable rate of interest to another party with no principal as exchange. So the principal is an exchange. It's just we're swapping fixed for variable, and it's a way of making variable rate securities, which are risky if interest rates change, making them safer by swapping them for a fixed rate. So one party may want to hedge and protect from interest rate exposure or change if they have a variable contract and they can swap it for a fixed, and the other party just may want to speculate that interest rates won't change a great deal and they're willing to take the variable risk for a fee and for a profit. Okay. There's also currency swaps where two parties agree to swap a principal and interest payments on a fixed exchange rate. So you may have one party that has, it's advantageous of them to swap. They have dollars. They may want to swap with someone who has euros. So two parties can swap principal and interest payments. So the firm borrowing the money in whatever currency has a lower interest rate than the swap payments into the preferred currency preference. Okay. So let me just go over a few more things. So the futures market, one thing to remember is that as an individual investor, you can't really take part in the options market. It's really for hedge funds and mutual fund investors. So if you look at options versus future contracts, in many respects, future contracts are closely related to options contracts. And option contracts are something as an individual investor you can trade on. And we've covered that last chapter. So both involve options and future contracts, both involve future delivery of an underlying asset at an agreed upon price, and both are considered derivative securities. So options and futures and forwards and swaps are all derivative securities. But there's a significant difference between a futures contract and an options contract. So to begin with, a futures contract obligates a person to buy or sell an underlying asset unless the contract is canceled or liquidated before it expires. So in contrast, an options, let me just restate that. A futures contract is an obligation to buy or sell the underlying asset of the contract. And so you have an obligation here. But the option gives the holder the right to buy or sell underlying asset, but does not obligate them to. So think of options. You have your options. You may want to get the asset at the agreed upon price, or you can let the option contract expire. Future contract is not like that. Once you engage in the future contract, you're required to fulfill the contract one way or another. So in addition, whereas the strike price in an option is set by the terms of the option contract and it's fixed for the life of that contract, much like a bond's coupon rate, future prices are established through trading. So they change over time, just like a stock prices change. So let's say you buy a future contract for wheat on a Monday morning. That contract establishes the price that you'll pay for that wheat several weeks or months later. So if you purchase another futures wheat contract with the same expiration date on that later that afternoon, the future price will likely be different because that price will change continuously like a stock price. So forces of supply and demand cause future prices to change moment for moment, whereas the option strike price is going to stay fixed. So there's just something to remember between these two things. So two other differences between options and futures that are important. For options, the option buyer, the risk of loss is limited to the premium, which is a small amount. Now, the future contract has no similar limit on losses. Therefore, while an option buyer must pay something, the premium, to the seller to acquire the option, the buyer and seller of future contracts do not exchange any cash up front. There's no premium. although they do have to make initial margin deposits at the futures exchange. And so the futures contracts are so much more riskier, and that's why individual investors are not allowed to trade them, because such extreme risks. And that's why they're limited to pension funds, insurance companies, hedge funds, mutual fund companies, and very large investors. Now, there's a number of different exchanges where future contracts can exchange. The CME, which is Chicago Mercantile Exchange, and the Chicago Board of Trade, the CBOT, are some of the two biggest. There's also the New York Mercantile Exchange, and there is the Commodities Exchange. So there are a lot of places where these can trade. And like we said, we have those hedgers and speculators that use the futures contract. Hedgers are trying to protect their positions from losses. Speculators are trying to make a profit. And both parties can use these their margin positions, which are very small. Some contracts you only need to put 2% down, and then when the contract comes due, so a future contract only lasts for, like an option contract, only lasts for a specific period of time, and when it comes due, we're going to mark it to the market, which means it's going to be priced at the spot price on the due date, and whatever that we have no control over what that may be. So so the contracts are going to, each contract, depending on the commodity, is going to have different specifications, and the price behavior is going to be different for each contract because it's going to be related to the underlying asset. So really, future contracts are for the big boys, and they're usually, one contract can be thousands of dollars to buy one contract. So that's why you also need a huge amount of money to get involved in the futures market. And as we were talking about before, the financial future market is one of the biggest of the future markets, where we're dealing with foreign currency, interest rates, stock indexes. So this is a way where a lot of hedging can take place, especially in times of volatile periods of economic change. Okay, so that is my review of the futures chapter and what future contracts are. So at this point, I would suggest that you read over the chapter 17 and talk into a little bit more detail about these different contracts and how they're structured. I think you'll find that very interesting. Thank you for your time today. I hope you found this lecture helpful.